Today we're going to discuss about the 3 worst mistakes that I made on stock markets that cost me a lot of money and the lesson that I got from them to become a better investor and to not do them again, because in all those 3 mistakes it's pretty much the same scenario all the time, pretty much the same narrative, and that's why I think it's important, and I think a lot of people do this kind of mistakes. So the first thing you need to understand with those mistakes is it was on a different strategy that I have now. My strategy before was fully focused on dividends. On dividend growth, okay? So I was investing in companies that had a good dividend track record, that could continue to grow their dividend each year, and that I could buy at what I was thinking, an interesting price at an interesting value. It doesn't mean that I didn't want any growth from this company, but the goal was absolutely not to beat the market and was to have higher and higher dividend every year. So with that said, the first mistake, I talked about it in a previous video, was Walgreens Boots Alliance. I started buying this company, I think, around 2021. I think I did my first buy around $45. Around $45, something like this in 2021. Then I added up again around $40 in 2022. Probably added up again around $35 in 2023. And it became one of my biggest positions in my portfolio. It was representing roughly 10% of my portfolio. And the thesis behind it was that the company is still growing the revenue. Okay, if we look at the total revenue for Walgreens Boots, it's growing. Okay, in the last 10 years, it's not growing fast, but it's growing by 3% per year. It's a company that made $152 billion per year. So this is something interesting. The only problem is that the net income was not following. We had net income, okay, 2020 very bad, 2021 it started to be better, but over the last 5 years it totally decreased and now it went negative. But from 2022 it was 4.3 billion, so it was like not the record, but it started to be back at the level that they had in 2018. And unfortunately it didn't continue, because right after this they became negative, minus 8 billion, and now they are around minus 5-6 billion. If we look as well as the way operating income have evolved, from 2023 it became negative. We had a nice growth till 2018, and from 2018 going down. And I invested in 2021, 2022, so I was expecting that the stock will rebound. I was giving like, oh okay, it's because of the pandemic. If the pandemic didn't happen, it will continue to grow, the revenue continue to grow, but no. After the pandemic, from 2019, the efficiency of the business really started to decline, and this is where the problem was. Like the operating margin, they totally decreased, and they got stuck from 2021, from 2019, and after up, it got down. And that was the problem. The management was not efficient, the management wasn't good, and I bought too expensive. I didn't study correctly the management. I didn't have all the process that I have now to study the management. And I thought like, okay, the revenue is growing. It's a huge company, too big to disappear. You have Walgreens everywhere, and it will go up again. After all, it's 50 years of constantly increasing the dividend year after year. But there is other ratios that are not good. If we look at the PE ratio, I invested when the PE ratio was super low. So it could be good, but the problem is, it was starting to be low, but historically, it wasn't that low. It was a bit low, but wasn't that low. So I started to buy a bit too fast this company. I started to buy way too fast. Also, when you look at the return on capital employed, for example, it was decreasing year over years. Okay, return on capital employed decreasing, and in 2020, 1.6%, 4%, 2.1%, and invested when it was around 4%. So really bad. I thought it will go up again, but no, it was a downward trend. Same for the return on capital invested. Downward trend, and I invested when it was very low. So yeah, the management give a lot of signs that it was bad. And the mistakes here, I bought too expensive. Okay, like if I studied more the business, with the knowledge that I have now and so on, I will see that first, it's too expensive. Second, it's really not good quality. I'm okay with business with low margins because in this area, it's normal to have low margins, but you need to have high return on capital. And unfortunately, they didn't have, so I could have seen it because since 2019, we have signed that it's bad and I started investing only in 2021, 2022. So I had the sign, but unfortunately, I didn't I didn't look at them. I didn't pay attention to them. I was too focused on the nice 4 or 5% dividend yield that I could have with it. Then I was focused on the 6 or 7% dividend yields that I could have with it. And it was definitely a value trap. The second one is pretty much the same profile. It's Intel. So Intel, I started to buy same around 2021. So most of my mistakes, it was around 2021 that I made them, okay? Same, I had this dividend strategy. With Intel in 2021, the dividend yield was around 3%. So I was like, okay, not too bad. I didn't have any tech company in my portfolio. For me, Intel was a giant. So I was like, okay, let's start a position on Intel. So I bought around $51 in 2021. I added up a little in 2022, around $40. And then probably a little more, around $30 in 2022, something like this, around $35. It was getting bad. The CEO was fired 1 year after, new CEO, and 1 year after, again, CEO out. They don't find any solution. The management have no idea what they are doing. And the big mistake that I made here is that the company in 2023 had a huge rally. It took almost 100% in a year, okay? And here I didn't sell. I was in front of my broker. I was an interactive broker. I was like, okay, do I sell? I know the company is not good now and so on. I decided not to sell because I was like, no, it's $48. I bought at 52. My price of entry is 52. So I want to be in profit to sell. So I didn't sell for what, 5 or 6% or 10%, something stupid like this. And then it went down again and I ended up selling at $30. I ended up selling at $30, which with a loss on it. And same, we had the sign like with Walgreens with Intel. So we started having first revenue declining in 2022. So unfortunately here, I started when the revenue was all-time high. I didn't expect the revenue to start declining in 2022. I expected a bit of decline, but I didn't expect such a huge decline. So yeah, this really hit hard and I should have sold immediately in 2022 when I saw the revenue declining like this. The net income, same, okay, really bad way. Like net income, 2022, it got divided almost by 3. Okay, it got divided by a solid 2.5. Then again, and then totally negative. So same, I should have sold in 2022, but I was a bit more naive than today. The management were like, okay, we're just doing a transition right now. We're entering in this business. It will be way more profitable. It will be way better. And unfortunately, nothing happened. The operating was really bad. When you look at operating income, you could have a first look that the operation were not really good because in 2021, you already had like this decline, okay? We can put it in annual, but in 2021, you had the first decline from 23, almost 24 billion to 19.5 billion. You had the first one. So it could be the clue. And I should not have invested, but unfortunately, I didn't have the same way of doing that now. The operating margins, you were thinking that they are nice. A little decline in 2021, but they're still high, 20%. 2022, it went to 3% and now negative. So you had a lot of sign. When you look, for example, at the cash flow, you can see the free cash flow. Same, 2021, huge decline in free cash flow. 2022, it was already negative and it never went back to positive since then. So that's something that could have been a hint. When it comes to capital efficiency, when we look at the return on capital employed, 2021, it was 12%. So it will be a no for me today because I don't invest with less than 15% of return on capital. So here it could be tricky, but yeah, you had some signs. You didn't have all of them, you had some signs. And when it comes to debt, you had some signs as well with quick ratio eventually, but the debt was kind of fine, to be honest. Like the debt was kind of fine, except obviously now, but the debt in 2021 was 1. Net debt to EBITDA was 1. 2022 too, so it's still fine. And then from 2023, it started to be like really bad. So here, same, I bought too expensive. I did a bad buy. I just bought the company because the price was going down, because it had 15 years of dividend increase. It was one of the tech company with the most increase of dividend. Let's say it's the biggest track record of increase every year. So that's why I bought it. Lesson learned. Luckily for me, it wasn't as big of a position that Walgreens was. It was a bit less. It was 4% of my portfolio, but it's still something that I could have not done, and especially that during this period, if I just invested in S&P 500 ETF instead of those two stocks, I would have earned way more money. The last one is Leggett Platt. So same again, it was a dividend king, huge historic, a boring business. Okay, it's component for bed, for chairs and so on. So a very boring business, apparently easy to operate. I started buying same in 2021, 2022, I think around $40. I started buying, and then I added up again around $30. And same than Walgreens, it started to be 20% of my portfolio, 10% of my portfolio. Here, the other reason that I saw was that they really did well during the last big recession in 2008. So I was like, okay, they should manage if there is something. Unfortunately, they entered in kind of a recession for this particular area, and they didn't manage to get out, and it lasted way longer than expected. I thought the recession in the area would be way shorter, but no, it was a long one, a slow one that doesn't do any, like it's very insidious one. So I got trapped. Okay, so here we had in 2022 a little higher sales, okay, and then from 2023 it started to decline, and this is where I should have sold automatically in 2023 or 2024, but I really thought it was a problem that will last only 1 or 2 years and it will go back, and that the price was good. But two problems here: I bought again too expensive, and the management was kind of lost. So I'm happy that I did those two mistakes. It's exactly the same way than with the other. You can see the operating margin starting to decline from 2021, from exactly when I started to invest. I should have passed because the margins are too low, okay? Too little margins and declining since almost 10 years. So I should have not taken it. Same with, you can have a look at the net income. Obviously, it went back in 2023, really down. When we look at the return on capitals, where is it? It would be in capital efficiency. Return on capital employed, it went down really bad since already 10 years, okay? And in 2020, 2021, we had a high and then went down. So I should have got the hint from all of this, seeing it's declining, and it's not declining from 40% to 30% or 25%. It was declining from 20%, which was really good, to 11%, which started to be way too low. We can have a look as well at the debt level. If we look at the debt level, the debt started to be not well managed. You can check the EBIT to interest expense. Okay, it started to go way down, and net debt to EBITDA, same. EBIT to interest, net debt to EBITDA, it's growing year after year. It's growing, and we don't like to see this. And in 2021, 2022, it started to be too close to 3. So I should have a first sign here. And the EBITDA to interest expense was declining year over year. I will take the EBIT. I prefer with the EBIT here. Was declining year over year, and this should have been an alarming sign for me. I had plenty of yellow flags that now I will consider as a red flag, but I was like, no, this company is a king dividend, 4-5% dividend yield, a really solid track record, did very well during the last recession and so on. So I decided to go, and it was a bad mistake. Another thing is I was getting this investment idea from newsletters, so from some online newsletters that are specialized in dividends, and this is how I was getting ideas to find stocks. And then analyzing a bit more with the report that they were doing. So yeah, not really good experience with this kind of newsletters, and definitely now I'm happy that I did those mistakes, because they probably cost me something around $10,000 or $15,000 in total, maybe a bit less, around $10,000. So yes, it's still pretty much some money, okay, but I was young when I did them. I was less than 25 years old. I was starting investing. I was on a strategy that was good for me. At the end of the day, this strategy made me some money, okay? So it's not because I did 3 mistakes like this that I didn't earn any money. It made me some money. And if I didn't make those mistakes, I would not have the strategy that I have today, which I find very efficient, which I find very good. For now, I have good result with it. So without this, let's say, bad experience, I would probably never put back myself on, I would not be like self-critical with myself and say, okay, this is not going the way you want, so let's change the strategy. So I'm happy I did it very early. I am happy I didn't do this mistake when I'm 60, 65 and when I don't have that much time to correct everything and so on. I did it when I was young. This money, I could earn it back, like, I'm not saying easily, but just have to work correctly and you can earn it back. So I'm happy at the end that I did this kind of mistakes. So let me know in the comment section if you have some similar story, similar stock, if it helped you as well to see what went wrong and how you can adjust to not make this kind of mistakes. And if you like the video, put a nice thumb up on the video. It will help to make it discovered to more and more investors.